Hey, everybody, welcome in. Listen, OPEC Plus just hit pause last week on any production hikes in the first quarter of 2026. A lot of people expected this to calm the markets and kind of quell some of the oversupply concerns. But what we're going to talk about is we're going to forecast a little bit into the future and identify that this may actually be the calm before the barrel storm. So let's go ahead and dive in. I'm going to be flying solo today. Bill is on the road. So let's go ahead and dive in and make sure to get the content out to you so that you can be along your way. So OPEC Plus just hit pause, but this doesn't really mean calm or surrendering to an oversupply narrative. What this basically means is that there is a breakdown of what this means for 2026. So there is concerns about oversupply, and those are valid. Those are valid concerns. So what is the headline? The headline is this. So OPEC Plus decided to come out. Of course, a lot of the news over the last week has been more around the U.S. government shutdown, but it looks like that's been temporarily resolved. So we're going to get back to the basics, which is what this means for the global oil supply and oil demand markets. So Saudi Arabia, Russia, Iraq, UAE, Kuwait, Kazakhstan, Algeria, and Oman reaffirm the commitment to market stability. Now, they did increase again 137,000 barrels a day in December, but we're going to walk through some of these increases and kind of show what is left and really what this means. So the production hike quota, now bear in mind this is not production, this is quotas. So OPEC Plus announced a pause in planned and added 137. So the market narrative is that the market interprets seasonal weakness. So there is seasonal weakness this time of year. It's not summer driving season. There are not other wedding seasons in India. There are a lot of seasonality. And right now, going into this season, this is a typical soft time of year. Now, another thing of note is that China continues to import oil at the same rate, even though their demand has fallen off. That is a true demand concern about oversupply, but it hasn't happened yet because they've kept their imports up. So offline capacity, there's roughly 1.2 million barrels a day offline versus target output. So we're going to talk a little bit about that target a little bit later. Um, the reality, this is really strategic compression. This is not a surrendering to the market dynamics, which are arguably a little soft right now. So in the October report, this confirms shortfalls despite production shortfalls despite the quota increases. So it basically means if you have a quota that is up here and your production is right here, you are actually underneath that quota. It means that the quota number, that is the number that is publicized as far as that is the production hike or contraction, is over what the countries in aggregate are producing. So non-OPEC supply, this is what the OPEC report reflects. Non-OPEC supply growth is slowing to 800,000 barrels a day in 2025. This, of course, is something that we've seen and we've been talking about because the U.S. is flatlined. It really hasn't grown too much, and I'll show you a little bit about that when we get into the data. So the inventories, the OECD is still below the 5-year average, and refining margins on diesel and jet demand have been rising. So refining margins have been increasing. So what are the big notes? In that OPEC report, when we look at individual countries, As we talked about before, when we're looking at the quota versus production, who's over target and who's under target. So over target, you have Iraq at 180,000 barrels, UAE at 100,000. Libya is technically exempt, but they're 70,000 barrels over. But look at this. These are all the countries that are under target. Nigeria is over 200,000 barrels underneath the target. Angola is 150,000 underneath. Iran, 120,000. Kuwait, 90. Algeria, 60. This is just a sampling of some of the bigger variables on over target and under target. So what does the demand picture show? So in global growth, we're still growing at 1.3 million barrels a day in 2025 per OPEC, and 1.4 in 2026. And Asia is leading that, with China adding 180,000 barrels a day. Now, this is a smaller increase year over year than we have seen out of China in a very long time. So the China is transitioning from a high growth, high percentage, high barrel per day importer to marginal, meaning you have bigger numbers from China, bigger numbers from Europe, bigger numbers from North America when you're looking at that. But all of those growth rates are now in a mature sense, meaning it might be 2% or 3%. The world got used to China growing at 7 or 8% every single thousand barrels a day. This isn't weakness. This is about momentum. Okay. So the hidden tightness in the fragile equilibrium is the stocks are tight. We have limited spare capacity, meaning we have brought on a lot of the constrained quotas. And we're now at a point where a lot of countries just cannot produce that much. So there's a lot of speculator positioning. Speculators are remaining net short, leaving room for a short squeeze. Disruption sensitivity. Every disruption, sanction strikes, weather will move the price very fast. And there is a rising volatility risk, which is increasing below the calm $60, $61 WTI. So the 2026 setup. Supply is under delivering while demand grinds tighter. The oversupply narrative is mostly psychological. There's really only one fact that is indicative of oversupply, and that is China. China, on their raw demand, is down, and because of that, it is being compensated with barrels that they're adding to their strategic petroleum reserve. So the compression today, this could lead to a snap later. We're not financial advisors. Read all the disclaimers below. This is our opinion, and that is what we provide. And I'll tell you a little bit about Energy Rogue when we get into the show and tell, when we get into the data. I'm going to go probably for another 10 minutes. So, but I wanted to walk through kind of the condensed version of what we're looking at. 2026 could shock for those that are betting on cheap oil. And in 2026, we think the crude markets are going to wake up. And by waking up, we're not talking about 60 to 80. We're not talking about 60 to 90. We're not talking about 60 to 100. It is a lot different and a lot bigger scale than what you might be thinking, because the past is not going to happen again. It is a new paradigm. So what are the key takeaways from this summary? Pause does not equal weakness, it's strategic positioning. And the fundamentals are tight, stocks are low, and demand has been strong, with the exception of China adding to the strategic petroleum reserve. Non-OPEC's growth is slowing. This is something we at Energy Rogue have been talking about for over a year. We expect volatility, opportunity in early 2026. So, what is the Rogue Insight? Markets see calm, we see compression. Energy Rogue helps traders and producers and consumers cut through the headline noise and act on what matters. So, the call to action. If you want to take action and really understand things. Now, the second half of this video, I'm going to be getting geeky. So, if you don't want to get geeky, you can go on about your way. So thanks for joining. I appreciate your time. We are going to get geeky. We are actually going to get in the numbers, and I'm going to show you how to find these resources so that you can actually construct ideas and thesis just like I just did. So you can get a 5 minute per day market plan before the market open. And you can join Rogue Radar. It's $89 a month, and there is a 14-day free trial. Just click the link below, and we'd be happy to see you. So we talked about the headline. So every week inside of Rogue Radar, we break down the markets in a video plus 2 PDF reports. One comes out Monday morning, and the other comes out later in the week. And that is Rogue Radar. That is our convenient red light, green light system where we talk about what is happening in the marketplace, and we get assigned different factors. When you're looking at natural gas, it's not just one thing, it's an amalgamation of 7, 8 figures, 8 different items. Crude oil, same thing. This is what we step through every single day in our system. So you'll have access to these reports, which some people sign up because they just want to hear our opinion. They want to hear what we're thinking, what we're talking about. So you get this every week, 2 videos, 2 PDFs, plus you get access to our natural gas radar and crude radar, where every day we actually walk through the market and we go through my thoughts of the day right here, and we talk about what is happening on the day. Today's update, which is an AI summary of my thoughts, news, technicals, everything. And each one of these updates every day with a new market summary, my thoughts of the day, today's updates, technical analysis, fundamental analysis, supply, demand, storage, stocks, international prices, OPEC analysis for the recent OPEC report, and then CFTC reports, news, all these different factors. If you consume all of this and read through this in 5 minutes, you're going to be prepared and you're going to understand the oil market. So let's get a little bit geeky and get into it. Let's look at non-OPEC supply growth, which again, we have been projecting this, that we are virtually flatlined. And what you see here is that after we moved up on our oil production to above 13 million barrels a day in 2023, we're now at the end of 2025. You can see we've ranged from 13.6 to 13.2. So that's not a big range. And that means that we have effectively stalled. So the number of rigs that we have active today is really just sustaining. Now, let's go a little bit deeper and get into the OPEC analysis. All right, when we are looking at OPEC, let's go back to 2022. And 2022, if you recall, there was price spikes in the marketplace because of the Russia-Ukraine war. And what did we see? That OPEC barrels is not OPEC plus, it's OPEC barrels, effectively peaked around 36 million barrels a day. Now, we have pierced above that. That's because there's been a lot of projects that have been worked on over the last couple of years, most of those in the United Arab Emirates. So let's look a little bit deeper. And by the way, on the US, what you can see here is a consistent trend down. This is how much production we're adding If you're above the zero line, you're adding production to the bottom line. If you're below the zero line, you're losing production. So then let's get into OPEC. Where is it? There we go. All right. So let's look at a couple things. And we are going to look country by country. I'm going to take all of these off. And this is inside of Rogue Edge. Rogue Edge is $179 a month. And this gives you access to ask these questions very quickly and conveniently so that you can get to the answers pretty quick. But what you can see here is you can see a big contribution. You could see that UAE back in 2022 to right here. That is pretty much a straight through representation of why we're up. So let's look at Saudi Arabia. And what we see here is interesting. Now, Saudi Arabia, they consumed most of the production cuts. So they have been lifting, doing a lot of the heavy lifting. So when Saudi Arabia gets, if they don't feel like there's adequate compliance to the marketplace, then they can ramp up production pretty quick. So this is OPEC liquids production. Okay, so this is not crude oil. This is more condensate. You can see a trend increasing there. But let's take a look at Nigeria. What's happened with Nigeria in 2022? Now they have been increasing, but their quota and their projections for where they were going to be producing are all the way up here. I think their quota is 1.6. So they are significantly behind the 8 ball here. So the key is when we look at which countries are going to be overproducing or underproducing, when we look in aggregate, OPEC plus, there's not much supply left. That means if demand is there, if demand continues to grow, OPEC plus is not going to be able to meet it, and non-OPEC sources of supply are in decline, and that means it is a recipe for increased prices going forward. Again, not financial advisors. This is just my opinion, and you can come over to Energy Rogue and you can join us, and you can get insight like this every single week. So the link below is going to take you here. You can read a little bit about that. You can also read some of our testimonials and how it's different, what you get, and right down here you can choose Rogue Radar or Rogue Edge. $89 a month, $179, and many institutional traders, hedge funds, energy traders from around the globe use our service, and we would love to see you inside. So hopefully that gave you a kind of a good breakdown of why we believe that 2026 is going to be a big market reset. So so listen, until then, until next week, stay safe. Hopefully this gave you a little bit of info. If you enjoyed this, please drop us a like, please share it, please drop us a comment. We would love to hear from you. And my name is Brian and I'm with Energy Rogue. And so I hope you have a fantastic day. Talk soon.